boy Kevin just lost lots of money. Oh, but that's okay. I am with you, with you. Oh man, your boy Kevin just lost lots of money. Oh, but that's okay. I am with you. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening?
Check it out, folks. Yo, what's going on, guys? Welcome to another video. Today's video, I actually want to talk a little bit more just about my thoughts. I want to make sure that I am extremely clear in how I feel about everything regarding the stock market and my personal plan. Again, you do not have to agree. A lot of what my YouTube channel is it's not me claiming to be an expert. It's not me giving financial advice. That's why I don't have a Patreon. That's why I don't have a Discord. That's why I don't have a course. I don't have any of that stuff because I don't consider myself to be a guru. And I think people should go on their own journey and learn what works best for them when it comes to investing. But it is my YouTube channel, and so I do share my thoughts. Okay, so just want to make sure that we're very clear on that. I saw somebody in the comments. Shout out to Johnny with the Stocks is Talking podcast. I think he's the one who made the comment. He was like, I see Echoes is showing off the house now. Echoes done upgraded and stuff. Well, yeah, I did upgrade. This house is bigger, nicer, better than the apartment that I had like a month ago now, however long I've been here. Honestly, I had no intentions of showing off this apartment at all. I really didn't. That's why I was hiding upstairs and what some people call me living in my mother's basement or under this, whatever you guys call it. But I was upstairs. But what happened was I brought my little tripod thing down here and I just wanted to see what it would look like. And I put it right here in the living room, and it looks good. The lighting looks good. I look good. I'm just joking. And the background looks way better, at least in my opinion, than upstairs. And the internet connection for some reason is better down here, even though the router is up there. So that's my spiel. I know you guys probably don't even care about that, but just wanted to talk about that. Let me go ahead and get my iPad. So I wanted to talk about the market and just overall how I'm feeling. I want to make sure I am extremely clear on what I'm doing. I am nibble buying. What does that mean? Well, if you got $5,000 in cash that you actually, let's go bigger than that, because we this is the time to make money, folks. Let's say I got $50,000 in cash, right? Nibbling is only deploying a few thousand of that at a time. And that's kind of where I'm at right now. Okay. So even though the S&P came down to 3,700, but the bottom line is at these levels, I'm just nibbling. Okay. I'm finding stocks that I like. You guys saw me talk about Google, saw me talk about Disney. Amazon isn't quite where I want it to be yet, but I'm licking my chops. I'm getting ready for it. Okay. But the bottom line is I'm nibbling. Why am I nibbling? Well, here's what we're going to pull up right now. And I've talked about this many a times. A lot of people are like, you know, why are you so bearish? What's your justification? Well, here's my justification. Whether right or wrong, whether you agree, at least I have a justification, unlike Stockmo, who's just randomly saying on his channel, I'm going to go bold here, guys, but I think that the S&P is going to go to 4,700, 4,900 by the end of the year. And it doesn't give a justification about it. That's been my main criticism of these grifters. Chris Sain, Stockmo, Larry Jones, they just regurgitate what CNBC says, but they don't actually have a thesis as to why. I'm going to tell you guys my reasons why. You may not agree, but here are my reasons. Let's go ahead and look at this chart right here. Okay. This little table. So you can see in this table, it shows all the bear markets all throughout the years. Okay. It actually goes all the way back to like 1928. But for right now, I have it going back the last like 50 or 60 years or so. Like 50, 60 years. So let's just go ahead and look at it. You can see right here, 1968 to 1970, that bear market, the S&P went down 36%. And it lasted 543 days. 1973, 1974, 48% is what the S&P went down. 1980, 1982, the S&P went down 27%. You just keep going. We're going to go to some notable years. The dot-com bubble, the 2000s, minus 36% is what the S&P did. 2007, 2008, that was rough. The S&P dropped 51%. And then even going to 2020, the S&P dropped 33%. So why am I saying this? Well, as of right now, the S&P is literally down about 19, 20%. It's not even down nearly as much as we've seen in some of these bull markets. And there are actually economists and people out there on Wall Street arguing that the economic environment in the situation that we're in terms of liquidity is worse than what it was back then. So I just don't understand why you wouldn't think that we would go lower. Now, Why have I said that I think 3,300 is where the SP is going to go? Now, you guys remember in the past videos, maybe like months ago, I said that the SP 500 was going to 35. I have no doubt that it's going to go there, but I don't think that's going to be where it's going to hang for support. I think where it's going to actually probably hang and could potentially be about, again, you can't predict this stuff. Don't get me wrong. I could be totally wrong, which is why I'm nibbling here, but I think the SP is going to go to 3,300. Why do I think this? Well, the S&P at 3,300 would be down 30% from the highs that we saw in January at the very beginning of this year before we had that huge drop. That would be 30%. Now, 31%, if I'm not mistaken, I think it was 31.65, would be a 34% drop from highs. Now, listen, bear markets on average since 1928, they got all the statistics. On average, going back to 1928, bear markets see an average drop of 34%. Now, my question to you, with the Fed being aggressive, with the Fed raising interest rates, with Jerome Powell not taking his foot off the gas pedal, with Jerome Powell starting to look more and more like Paul Volcker, with inflation still roaring, with everything going on, Ukraine and Russia, China and Taiwan, a bad president, I'll go ahead and say it, even though I voted for the guy, a bad president, what makes you think the market's not going to drop more? I'm just telling you guys the truth. I'm just telling you guys, why wouldn't the market drop more? To me, it just makes sense. That's where I'm at with it. Now, something interesting is happening that I honestly didn't expect. The market went down, it plunged a little bit yesterday, definitely went down. And today the market is down. I didn't expect that. I thought we might get a little bit of relief, but the sellers said, no, we're selling. So just wanted to talk a little bit about why that's happening. This Reuters article right here does a great job of explaining it. It says right here, analysis, no relief for bruised markets as Fed signals higher rates for longer. That's it. It's really that simple. Remember when there was this whole thing in the market that, the Fed's going to pivot. They're going to stop raising rates and everything's going to rally. Yeah, right. That was such BS. But now the Fed has fully told the markets to their face that, no, rates are going to stay higher for longer, whether you like it or not, because we want to fight inflation. So let's just read this article just a little bit. A Federal Reserve dead set on fighting inflation is leaving little hope that this year's rocky markets will end anytime soon as policymakers signal rate rises faster and higher than many investors were expecting. The Fed lifted rates by an expected 75 basis points and signaled that its policy rate would rise by 4.4% by year end and top out at 4.6% by the end of 2023, a steeper and longer trajectory than markets had priced in. That's it. If you shock the markets and they don't price it in, mudda she wrote. The selling comes. What's the old saying, folks? Don't fight the Fed. By the way, guys, let's all say a prayer. Rest in peace to everybody who put all their money in the stocks when the S&P was at 4,300. Oh, it's the top of the bear market. Oh my God, the bull market's back. Oh, it's unfortunate. I wouldn't be as mean if those people weren't so mean to me in the comments, but that's what makes me want to be mean to them because you were wrong. Okay. Yeah, I think that's really it from this article that I can see. It says right here, the S&P 500 is down 20% this year. Yeah, it is. It's finally back down 20%, guys, which means we're in an official bear market again. Oh, yeah, baby. Get excited. It's time to build some generational wealth. Come on now. Come on and dance. Let's shout. Okay, you guys get the point. That's Michael Jackson for those who didn't know. Reading more of this article, yeah, that's all I can see. So there you go. So I'm buying, okay, I'm nibbling, but I'm still bearish. And I want to make sure I'm extremely clear about that. This is not load the boat, lose your mind. This is for me. I'm shopping for deals, but I have in the back of my head, we're probably going to go lower. Now, why am I nibbling here? Because I could be wrong. This could be the bottom. And I highly doubt it, but this could be the bottom. And if this ends up being the bottom, at least I bought when it made sense instead of buying when the S&P was at 4,500. And let me speak again on dollar cost averaging because somebody made a comment. And I know I go back and forth with people about this. I feel like people, I'm going to blame myself here. I'm not even going to blame people. Maybe I'm not explaining it right. So let me explain one more time my thesis on dollar cost averaging, okay? I was one of those people in 2021. I'll be honest. I'll be completely honest. I was one of those people in 2021, and many of you guys were too, we kept dollar cost averaging on dips. And believe it or not, that was actually a great strategy in 2021 because stocks only went up. So if you just bought any dip in 2021, you still would have made money. That's how much of a great year 2020 and 2021 were. However, we're in a bear market now. We're in an environment where valuations matter again. Valuations didn't matter in 2021. That's why Upstart went to $400. That's why Netflix went to almost $700. That's why Costco was almost at $700. That's why Facebook was at like $300-400, something like that, whatever it was. That's why Apple had like a $2-3 trillion market cap, whatever it was. Valuations didn't matter. And that was a key mistake that a lot of us made. But we're better investors now. So we need to start acting like it. Dollar cost averaging into a stock that's overvalued is not wise. Dollar cost averaging into the SP 500 is wise. Dollar cost averaging into some other index fund that you might like, I don't know, is wise. If you dollar cost average into a stock that you believe, based on your research, is either pretty much bottomed, doesn't have further to fall, or is just downright either at fair value or undervalued, is wise. But my biggest issue is people are not taking into account valuations and they're just dollar cost averaging. And that's the same mistake people made in 2021. And I keep saying, I don't even think people understand how low we're going to go. I'm willing to make a bet with anybody at this point. Like I'll even make a bet. I mean, we don't got to bet like no big money. It could be like a pizza or a chicken sandwich or something, you know? I think me and Fabio got a little bet going on. I think Fabio said he'll send me a chicken sandwich if Meta goes to $80, which could happen. He doesn't think so, but I think it could. But anyway, I strongly believe that the S&P is going to 3,300. Let me go ahead and read something else. There's this analyst, okay? There's this analyst. Apparently, he's a really good analyst. Now, normally you want to be careful what these guys say, but I happen to agree with this guy. So I think his name is Michael Hartnett of Bank of America. He says that history says that the bear market ends October 19, 2022, with the S&P going to 3,000. And we say nibble SPX, which is the S&P, at 3,600, bite at 3,300, and gorge at 3,000. Okay. Let me go ahead and explain because I exactly agree with him. I do think that it's very possible. These are my levels. I think that the S&P will probably go anywhere between 3,100 to 3,300. That's what I honestly think. I would not be shocked if the S&P went to 3,100. I know some of you guys would be, you'd be like, oh my God, this is insane. But what I will tell you guys, again, let's pull this chart back up. Here's what I'll tell you. Some of you guys who think that it's outrageous for me to say that, go back and look at the other bear markets. Look at 2007, 2008. The S&P 500 fell 51%. Go back to the dot-com bubble. The S&P 500 fell 36%. 1987, 33%. 1973, 1974, the S&P fell 48%. 1968, 1970, the S&P fell 36%. So don't look at me and say, oh, you're crazy. There's no way it's going to fall that low. That's outrageous. When every single bear market in the past is telling us that it's probably going to happen. So here's where I'm at with it. 3,700, 3,600 on the S&P. I'm nibbling. That's where I'm at. I'm looking for stocks. I'm nibbling, you know, because again, you don't want to try and time the market, which I've explained numerous times on this channel that I'm not timing the market. But you know, at 3,700, 3,600, I'm nibbling. That's where I'm at. Believe it or not, guys, even though the market has fallen tremendously since the beginning of 2022, since the beginning of the year in January, there are still a lot of stocks in the market that are still overvalued. That's what I'm trying to explain here. That fully explains how much of a bubble we were in 2020 and 2021. The fact that stocks have already fallen, S&P has already fallen about 19%. NASDAQ is down like 28%. NASDAQ's been the bear market all year, but the NASDAQ's fallen like 28%, and you still have stocks that are still overvalued. Some of these stocks have fallen 50, 60, 70, 80%, and they're still overvalued. That's why I keep saying you got to be very careful what you buy in this environment. All that, I'm not saying that these small caps are overvalued, but what I'm saying is all these speculation growth stocks, Tattooed Chef, Palantir, SoFi, you got to be real careful with that. Now, don't get me wrong. I do hold SoFi, but it's speculation, pure speculation. I'm perfectly fine with losing all that money if it happens. But the money that you're holding to the side, that you're putting into the market for the future, where you're saying, these are my retirement accounts, this is my long-term wealth building, the last thing you want to do is put that into some speculation garbage or some overvalued foolishness like Nvidia. Okay, let's just keep it all the way 100 here. Okay, even Apple is technically overvalued. Okay, so I'm just keeping it real. Same thing with Microsoft. You know, some of this stuff got to come down a little bit more, in my opinion, before you start buying it. That's just where I'm at with it. Okay, so wanted to point that out because I actually like the way that this Michael Hartnett guy is explaining it. I actually agree. I think it's smart. And the reason why he's saying this, in my opinion, the reason why he's saying nibble at 3,600, bite at 3,300, gorge at 3,000, is because I think he's understanding that you can't time the market. He could be wrong. These are just levels that he's pointing out that he believes the SP could go to. So for all we know, the SP 500 could just go to 3,600 and it could go to 3,300, but it might not go to 3,000. So if you bought, you'll be happy that you bought. And then depending on where the market goes from there, you could reassess and evaluate. You could determine what your buying strategy is going to be from there. But don't be surprised, folks, if the SP goes to 3,100 or even 3,000. It can happen. It absolutely can happen. And I'm here to tell you, I think at the very least, the SP 500 probably will fall at least 30% from the highs, which would put us at 3,300. That's just my honest opinion. So just want to make sure that my strategy here is very well explained to you guys, because I don't want anybody over here, I thought you said, don't do that. Don't do that. And again, I want to make it extremely, extremely clear. I am not your financial advisor, okay? I am not telling you what to buy or anything like that. I am giving my thoughts. If you happen to agree with my thoughts on my strategy, then you go ahead and you do what you want to do. But I do not advocate following anybody on YouTube, anyone on YouTube. I do not advocate following that. What I advocate doing is listening to them, learning on your own. And if there's some things that you agree with them on, then you go ahead and do what you're going to do with your own portfolio. But once again, there's a reason why I don't have a Patreon, a Discord, some course. I don't have a course member live stream. I don't have any of that because I don't consider myself to be a guru. And I'm also not a freaking grifter. Okay. I don't even have sponsorships. That could change, by the way. But as of right now, I don't have any sponsorships. The only sponsorship offers that I get is just all the garbage. Freaking Mumu won't leave me alone. Please take our sponsorship. No, I don't want to be one of those cringe YouTubers. This video is sponsored by Mumu. Get your free stock. No, no Weeble. I'm not getting sponsored by you. So to all the sponsors out there, if you want to come on my channel and sponsor something cool like the new Star Wars coming out, or a Star Wars coffee mug, or something regarding anime, something that I actually like, that would be great. But Mumu, I'm never sponsoring you on my channel. I don't care how much money you're willing to pay me. It ain't happening. I'm sorry. Okay. All right, guys, that'll go ahead and conclude today's video. Thank you guys so much for watching. Feel free to like, share, and subscribe, and I'll see you guys in the next one.